Hey, Dennis Tubbergen here. It is Thursday, March 8. I've got another video economic update for you. On the screen in front of you right now, I have a Bloomberg article, and the title on the article is a little bit scary. JP Morgan co-president sees possible 40% correction in equity markets. And the subhead here, bankers' comments come as investors fret about rising rates. He says there will be a market's correction at some point. That's really not a really bold prediction, saying that the market's going to correct at some point. However, what he talks about in the article is pretty interesting. You can see from the article, J.P. Morgan Chase & Company executive Daniel Pinto warned equity markets could fall as much as 40% in the next 2 to 3 years. His comments come as investors worry over the effect of central banks raising interest rates and rising inflation. It could be a deep correction, said Pinto. It could be between 20% and 40% depending on the valuation. The article notes the S&P has gained about 47% since February of 2016. Now, I happen to agree with Mr. Pinto. In fact, in today's market analysis, I show you some chart analysis on stocks, and we believe that there is a reasonable probability that a downtrend has already started. But just one simple thing here to pay attention to. The S&P 500 index has gained 47% since February of 2016. 47% in 24 months. That is simply an unsustainable rise. If you look at that price rise on a chart, we call that chart pattern a parabolic chart pattern. And most times in our experience, when you see a parabolic chart pattern where prices go straight up, prices then follow the up act with a down act. And it often takes about as long for that to unwind as it does to build. And often it ends up where it started, which would mean that we've got a pretty significant correction potential ahead. We also think that we're going to likely see a recession moving ahead, despite what all the good news potentially in the market is. One of the reasons is that if you take a look at the yield curve, which is the spread between 10-year and 2-year treasuries, you see we've got a price chart here going back, about 30 years. The recessions are shaded on the chart. And you'll notice that preceding each one of these recessions, you see the yield spread rising. And whenever you see it rise, you see that a recession has followed. Now, that isn't always the case. It's got to rise from fairly low levels. So you see this did not follow an official recession, but now we're seeing a bit of a rebound here. And you could see that potentially we could have a recession moving ahead. That all plays into a stock market correction as well. So again, if you're holding stocks, we would advise you to have an exit strategy in place, whatever that is, and make sure that you do have something in place, particularly if you're going to need to use the money and you're approaching retirement, so that if we do see a 40, 50, 60% correction, it won't devastate you. That's today's video economic analysis. It's March 8, and I'm Dennis Tubbergen.